I think we might have a recession coming. And as investors, we have to figure out what to do about that. And I think that the Fed going back to easing again is the way the markets responded today. It's good for gold and silver. And with the amount of money that's in the world right now, the amount of credit that's out there, the amount of bad debt that's out there, precious metals are a very attractive conceptual investment. And the Fed cutting interest rates just gives an extra excuse to anybody who wants to load up on precious metals. So, I think that's the picture from the standpoint of gold bugs and stackers, is that we're heading in the right direction for the next leg of the bull market.
As the U.S. Federal Reserve contemplates its next moves, financial markets speculate about potential interest rate cuts and their far-reaching implications. Fed officials have signaled expectations of one rate cut in 2024 and four more in 2025, a shift that could have significant consequences for everything from travel expenses to precious metal prices. JohnRubino, a respected financial analyst and author known for his insights on economic trends and alternative currencies, suggests that central bankers are eager to return to what they consider normal, lower interest rates. Rubino posits that even a month of negative inflation could give the Fed the justification to initiate rate cuts, possibly as soon as their next meeting. This sentiment echoes the delicate balance Federal Reserve Chair Jerome Powell described recently. This is no longer an overheated economy. We now face two-sided risks. We could hurt economic activity if we loosen policy too late or too little. If we loosen policy too much or too soon, we could undermine the progress on inflation. The potential for rate cuts comes amidst growing concerns about an economic slowdown. Rubino and many other analysts see a recession as likely in the coming year. In response, the Fed is expected to ease monetary policy, a move that could have mixed effects across various sectors of the economy. One notable beneficiary of such a policy shift could be precious metals. Gold, in particular, has been on a bullish run, with prices hovering above $2,400 per ounce as of Friday. The metal is poised to extend its gains for the third consecutive week, buoyed by speculation that the Fed might begin its easing cycle as early as September. Please tune in for our exploration of JohnRubino's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
This high interest rate thing is very unnatural for central bankers in today's world. And they want to get back to what they consider normal, which is interest rates much lower than they are today and money much easier. So this gives them a little bit of cover for doing something like that when even 1 month of inflation comes in negative, when it's something they already wanted to do. Maybe that'll be the excuse that they need. And then at the next Fed meeting, they'll actually cut interest rates a little bit. I would say that from the standpoint of where we are in the economic cycle, that it is time for interest rates to start going back down. But I wouldn't want to say that there are any policy options left for the Fed that saves the current system. This is strictly leaning against the coming recession. But there is no interest rate that fixes the fiat currency world or fractional reserve banking or global military empire. There's nothing monetary policy can do to fix the big things that are broken. So it could well be that we're starting to see a slowdown, and it might turn into a recession in the year ahead, and the Fed's going to ease and everything. And those normal things will happen. But the bigger picture is much scarier than that. So I think we might have a recession coming. And as investors, we have to figure out what to do about that. And I think that the Fed going back to easing again is the way the markets responded today. It's good for gold and silver. And with the amount of money that's in the world right now, the amount of credit that's out there, the amount of bad debt that's out there, precious metals are a very attractive conceptual investment. And the Fed cutting interest rates just gives an extra excuse to anybody who wants to load up on precious metals. So, I think that's the picture from the standpoint of gold bugs and stackers, is that we're heading in the right direction for the next leg of the bull market. All economists and financial analysts have indicators that they like, which they believe have some kind of predictive value. And there's dozens of indicators out there, and everybody has their own favorite set. But right now, there's a gigantic number and a growing number of indicators that are pointing towards a recession. Now, the way this works, an indicator is some kind of financial data series, and you can graph it, and you see what it did before the recession of the 1980s and the recession of the 1990s. And if it does the same thing over and over again, and a recession ensues, then it's got predictive value. There are tons of stats out there today that are all pointing in that direction. They're all doing that thing that they did before the 1990s dot-com bubble burst or before the housing bubble burst in the 2000s. You really got a nice choice of indicators all pointing in the same direction. And, the jobs market is one in the US where it's not nearly as healthy as it seems. And we're starting to lose full-time jobs, which you wouldn't be doing in an expansion. And all the real estate indicators now are pretty much terrifying.
Despite today's challenging housing market, characterized by high mortgage rates, steep home prices, and sluggish sales, many experts maintain an optimistic outlook for eventual improvement. However, prospective homebuyers are in a frustrating holding pattern as several economic factors delay the much-anticipated market shift. One of the primary obstacles is persistent inflation, which has been slow to cool off. This stubborn inflationary trend has forced the Federal Reserve to maintain its aggressive stance on interest rates, postponing any potential cuts to the federal funds rate. As mortgage rates indirectly follow this benchmark rate, which has been at its highest level for over 2 decades, borrowers are facing unprecedented challenges in affordability. JohnRubino offers a sobering perspective on the housing market's current state. He suggests that we may approach a critical juncture, noting, home prices have risen significantly in recent years, surpassing the increases seen during the 2000s housing bubble. However, affordability is becoming a major issue, typically leading to price corrections. Let's get back to the interview.
Home prices go up until they become unaffordable. And then they have to go back down because by definition, if nobody can afford a house, prices have to fall to allow them to afford houses. And we're kind of right at the end of that process right now. Home prices have been going up. Actually, we still think of the 2000s as the housing bubble decade, but house prices have actually gone up more in the last few years than they did between like 2004 and 2007. So we're back in that place again. Only this time, there are some new players with massive amounts of houses on their balance sheets that are likely to panic. And so that's why when you see home prices going up and inventories going up, but sales not rising to match those other numbers, you get kind of what we have today, where people can't buy houses, but there are still cash buyers like Wall Street hedge funds in the market pushing up prices. But it can't go on for much longer. And in housing in particular, you got these new players coming in. One is the Airbnb industry, which really barely existed back in 2007. But now, in the last few years, times have been so good in the housing market because interest rates have been so low that you see a lot of people having built up little empires by buying 17 houses or 25 apartment units or whatever. Things are no longer working out for these guys the way they hoped that they would. It's just not that profitable a business now. That's leading to a lot of them, and interest rates are up. So to the extent that they have to refinance their properties, they have to do it at a higher rate. So they're making less money. Their interest costs are rising. And a lot of them are looking at cash crunch, leading to a default, leading to bankruptcy. So you're going to see a lot of those guys start dumping inventory going forward. That's almost a given. And then all the private equity companies and hedge fund companies that have been buying up whole neighborhoods for cash and then converting them to rentals, when prices start to roll over, that'll pull rents down, and that's going to make their business model a lot less tenable. And they've got huge inventory. And what Wall Street normally does is they pile in towards the end of a bubble. The guys that got in last have to start selling because when the bubble bursts, they go bankrupt first. We'll see that again with the private equity landlords out there. So potentially what we're going to see is housing roll over and then all this inventory just pour into the market, leading to a big decline in home prices. Very hard times in the home building industry and the ancillary industries that feed the home builders, lumber companies, factory or furniture makers, people like that. So you get the the potential for a pretty serious recession just from a housing bust. But we've got all kinds of other things going on right now. So the everything bubble is not going to be just one bubble. It's going to be a bunch bursting either sequentially or all at once. We'll have to see. But we've created the conditions for that to happen in the next year or two. So, and again, the Fed is aware of this. They see the potential for a lot of things to roll over, causing very big crises out there. And they really want to start easing to try and head that off. And that's where they are right now. So they'll take whatever excuse they can legitimately hide behind to start easing. It might be September, it might be after that. We can't know that, but it's very possible that it happens sooner rather than later.
As we navigate this uncertain economic terrain, with potential interest rate cuts, recession fears, and housing market volatility on the horizon, what do you believe will be the most crucial step for average Americans to take in preparing their finances for the next 12 to 18 months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.